Good morning, everyone. I'm really pleased that I've been given the topic of capital gains tax to speak to you about today, because for the last 5 or 6 years, before every one of these budget events, I've been saying to anyone that will listen to me that CGT rates are going to go up. I've been arguing that they're at historically low levels and that simply can't continue. Well, yesterday, thankfully, I was proved right. Turns out that my earlier predictions were not wrong. I was just slightly ahead of the curve. So the good news, the good news is that the headline rates, while the headline rates have increased, the frightening numbers that were rumoured before the budget have not materialised. The much talked about 39 or even 45% rates are thankfully nowhere to be seen. Instead, we've got more modest increases to the rates from 10% to 18% for basic rate taxpayers and from 20 to 24% for higher and additional rate taxpayers. The rate for trusts has also increased from 20 to 24%. Now, for the sale of residential properties, the rates were only increased in April, so they've not changed and remain at 18 and 24%. Now, while the rate increases might not have been severe as first feared, the sting in the tail is that the new rates apply for disposals made from yesterday. It's at least some comfort to those professionals in the room that those late nights over the last few months working hard to complete transactions before the budget were not in vain and have actually likely saved clients money on their tax bills. There are no changes to the annual exempt amount, which has seen some dramatic cuts in recent years. These remain at £3,000 per individual or £1,500 for a trust, and there's been no tinkering with the use of losses. Payment dates for CGT are also unaffected, with tax on residential properties still being due within 60 days of the sale. Alongside the headline rates of CGT increases, there's also some changes to rates for gains which qualify for either business asset disposal relief or investor relief. Now, broadly speaking, a gain qualifies for business asset disposal relief if it consists of a trading business or someone who owns more than 5% of shares in a trading company. As well as this, the person making the disposal must have owned those assets for at least 2 years leading up to the disposal, and if this asset's the company shares, that individual also needs to be an employee or office holder of the company for that 2-year period. For investor relief, the individual needs to have subscribed for shares in the trading business at some point since March 2016 when the rules were introduced, and they've held those shares for at least 3 years prior to the disposal. Now, previously, gains that qualified for these two reliefs were taxable at a rate of 10%. Now, the changes announced yesterday increased that rate to 14%, but only for disposals taking place after the 5th of April 2025. The rate increases again to 18% for those disposals taking place after 5th of April 2026. In another slight tweak, the lifetime limit for investor relief is being cut from 10 million down to 1 million, and that brings it in line with the lifetime limit for business asset disposal relief. Now, changes to these reliefs were widely expected in the budget. However, I think it's safe to say that both the size of the increase and the soft landing period, they're not as scary as they could have been. Despite that, they will have significant impacts for SME businesses and those looking to exit trading companies. So let's have a look at the impact of those changes using an example. So in this situation, we've got two individuals that own 100% of a trading business. They have done for the last 10 years. They're co-founders, directors, they're higher rate taxpayers. Now, they've agreed a sale of their business, and as a result of that sale, they'll have a total gain of around £5 million. So based on this, they meet all the definitions to qualify for business asset disposal relief. Now, if they were on it and very wary of potential CGT changes and managed to complete the transaction before the budget, their CGT position would look like this. The first £1 million of gains for each individual is taxed at 10%, and the balance taxable at 20%. It gives a combined capital gains tax liability of £800,000, an effective rate of 16%. Now, if the sale wasn't quite completed before yesterday, and instead completes between now and the 5th of April 2025, the position is slightly different. The first £1 million each is still taxable at 10%, but the balance is now taxable at the increased rate of 24% rather than 20%, seen on the last slide. This increases the overall CGT liability to £920,000, with the effective rate increasing to 18.4%. Delaying the sale until after the budget has cost these individuals £120,000. So if we take this example one step further, and the sale completes in the 25-26 tax year, the position becomes even worse. Instead of being taxed at 10%, the business asset disposal relief gain goes up to 14%, with the balance still at 24%. The total liability is now £1 million, which is a £200,000 increase on the first example. The effective rate of CGT on this transaction is now 20%. Now finally, taking it to a worst case scenario, if the sale takes place after the 5th of April 2026, the CGT goes up even more. Business asset disposal relief is now at 18% and the balance still at 24%. The CGT liability is 1.08 million, or a rate of 21.6%. If you look at all of these examples together, you can see that while the overall rate changes are not as severe as we first thought, they do have a significant impact. If a business sale completes post-March 2026, compared to one that was sold last week, there's an increase in the effective rate of tax of 6%. In the example I've used here, the CGT liability increases by almost £300,000. And I think the takeaway to this is if you're looking to exit a business within the next few years, consider the impact of these tax changes. As always, the key is to get professional advice before making decisions so that you can be fully informed. Now, just a few smaller points. There were no changes to any other CGT reliefs announced yesterday, so things like holdover and rollover relief remain as they were, despite quite a lot of speculation that they might change. And as you would expect, there are various anti-forestalling arrangements and anti-avoidance rules in place for transactions which exchanged prior to a change of rates but complete after. However, as long as there's some kind of genuine commercial reason for the delay in completion, disposal should be unaffected and the lower rate should still apply. Again, if you're in any doubt, claiming professional advice is vital. There's some similar anti-avoidance provisions for people looking to disapply the share-for-share exchange rules, and anyone who falls within that category should speak to their advisor. Now, in the lead up to this budget, CGT was one of the main things that clients were worried about. But looking at the Treasury's own figures, the £40 billion of tax rises announced yesterday, the capital gains tax rates, and all of the changes to CGT contribute less than £1 billion. So it's around 2% of the total changes. It shows that the increases to CGT are not primarily to raise revenue, they're ideological. Higher CGT rates are something this government is looking to implement in order to remove the benefit of taking capital profits rather than income. Now, at the risk of being ahead of the curve again, it would not surprise me if we see further capital gains tax increases before the end of this Parliament. Thank you.